Welcome back to Value Creation Nation, everybody. This is Lane Taylor, your preliminary host in the very beginning. I was really excited to join Gene and Scott on the first episode in the pilot episode. But today we're going to tackle another important topic in the world of Gene and Scott and what they really want to create with Value Creation Nation. And so in the first episode of the pilot, we explored how organizations create value by aligning strategy, people, processes, technology, and execution, and why technology alone isn't enough to solve today's business challenges. If you have not listened to that conversation yet, I encourage you to go back and start there. If you're on Apple or Spotify or YouTube, click back, go listen to that quick conversation, and it provides the framework for everything that they're going to discuss moving forward. And again, I may be on some of these shows to help Gene and Scott. So today we're going to be tackling and talking about a framework and applying it to one of the most important and often misunderstood drivers in business performance: inventory management. So Scott and Gene, welcome obviously back to your show, Value Creation Nation. I'm going to tee it up for you, Scott. First off, why are so many company leaders so concerned about how much inventory to carry, where to store the products, and how to manage them? So let's talk inventory management. Let's dive in.
Yeah, so let's unbundle that a little bit, because you touched on a lot of topics simultaneously. So the outside of people and the investment of people, the second biggest investment that a business is going to make is related to the inventory that it uses to satisfy its customers, right? That inventory, where it's purchased from and where it sits in support of customer demand, are critical decisions in one, determining the level of inventory that needs to be carried and the level of support that the inventory they're carrying can deliver to satisfying their customers' requirements, right? Amazon bursted on the scene and basically changed the paradigm of how inventory is managed and what the consumer's expectations are related to the order to delivery time frame. Amazon continues to move that needle, right? From a 2-day service, they quickly have moved to a 1-day service, moving more specifically on certain items to within hour service. So with that, the rest of the industry is sort of trying to keep pace and trying to figure out how they stay competitive with that sort of heightening, we call it service level. And so when we use that term, we're really looking from a consumer perspective at the time the consumer hits the order button to the time in which it's in that consumer's hand. How long does it take for that to be able to be delivered? So we'll unbundle that during the discussion that we're going to get into today. But at a very high level, being able to deliver on a very high service level impacts where I service product and or the transportation costs that have to be absorbed to be able, wherever it's stored, to be able to deliver it to the customer or consumer. The consumer, in the end of the day, isn't concerned with where the business has the inventory stored. They just care from their perspective. I hit the order. I want to receive it in a certain period of time. I expect you'll get it to me. So we'll talk today about the 4 key components that make up inventory management and inventory planning. We're going to talk about demand and demand variability. We're going to talk about lead time and lead time variability, which are the 4 critical components that are analyzed in determining not only the stock that's being carried, but the safety stock that's being carried. That safety stock historically has been viewed as that cushion of inventory to ensure a high level of serviceability to their consumer demand. So that investment in inventory continues to be a question, particularly in these times of tariffs and the incremental costs that businesses have had to absorb related to where we've gotten to as, the China being the primary producer of the world. So as tariffs go up, the cost of those products go up. So businesses have had to do more to be able to plan inventory, think of inventory, and try to minimize their investment in that side of the business. Gene, you have any thoughts you want to add?
Yeah, just to stay at the high level for a moment, because I want to make sure what context is set up here. Inventory is the number one reason a business is in business. What products are we going to sell? To whom are we going to sell them to, and in what markets? So this needs to be attacked all the time, daily. It's got to be a dynamic kind of issue. It's not something that's so static. And Scott's touched on some of the ways you illustrate that by service from the customers, and we'll get into that. But I think for profitability, for cash flow, and for competitive advantage, we talk about inventory as a strategic weapon. It's really a competitive advantage, because what you do has to not only be profitable and improve your cash flow, therefore staying in business, but delight your customers. So it is the number one issue for a business, and that's why people struggle so much to get it better.
Incredible. Well, let me me just ask this question because I'm very curious, obviously, with the show with Value Creation Nation. And a short plug, real quick. Guys, Gene and Scott, obviously, we talked about it on the show and you heard it in the very beginning. emakeconsulting.com is the place to go to work with these two fine gentlemen to help do everything that they are talking about. But with that, guys, Value Creation Nation, right now, with what you're doing, the time, the money, the energy that you're putting into this, why inventory management? Why do you want to have this conversation? Why should someone say, you know what, I'm going to listen to this today? What do you want the byproduct to be after they listen to this?
Yeah, most companies do use Band-Aids, I'll put it, to get at their inventory question. They work on their forecast, the sales forecast, and try to get that down to a higher level or lower level of error. They work on planning. They work on one thing after another, but they're not comprehensive, holistic ways of improving their inventory overall. And so I think that's the number one issue that companies face. There's no magic bullet out there. You have to do several things on a dynamic basis to really get your inventory under control. Scott?
So think about it this way at a very high level. Working capital is at a minimum, is at a premium right now, right? There are a lot of strains and pulls on how money could be used to not only support the business, but enhance the business. Inventory is the biggest consumer of your working capital. So the question becomes, how do you not overinvest in inventory? How do you have a robust supply chain that can keep inventory contained, yet keep a high service level? And how do you keep working capital free so that you can go and invest in the other opportunities that are presented to the business that will help expand the business and grow the business, right? So inventory is critical because it is a huge consumer of working capital. And so the way the supply chain is constructed, where you buy impacts the lead time impacts the amount of inventory that has to be carried, right? Which impacts your serviceability and your ability to respond to shocks in demand. We sort of lost sight of that, way back in the 80s and 90s as we transitioned from a domestic-based manufacturing base to an international base. The one thing that we sort of left behind was the idea that long lead time drives inventory. And at the time, buying inventory, was cheap to do. Now it's become a premium, particularly as interest rates continue to climb, right? Keeping it contained and finding new strategies that help sort of minimize that, yet keep high serviceability is critically important.
One more principle I'd like to convey here is that the end-to-end thought. You spend money to buy products or materials to build them. You don't collect on that until they're sold. So the time from when you buy something, you make it and move it and ship it and all that to collect, that's the supply chain time, total supply chain time. Now, where cash flow comes into it, because as Scott said, working capital is a major user of your capital. And so what you'll hear us talk about some is free cash flow. At the end of the day, when you close your financial books for whatever period you're doing, what's left over after you pay all your expenses and so forth is free. You can either invest it back in the company, you can pay it out to your shareholders, or you can buy some other company. That's what free cash flow really means. And so that's why inventory is so critical to your business continuity.
It's interesting, gentlemen, and you all know this, but maybe the listener doesn't. When I lived in Florida about a year ago, we lived in an area that, speaking of Amazon, we would order items and it would take 2 to 3 days just because of maybe a little bit of the place that we were. And then when we moved back to Knoxville, Tennessee, we actually moved about 6 minutes away from an Amazon distribution center. And I remember we were sitting here and I ordered something and it was at my doorstep within like 4 hours. And it wasn't a very common item. And I'm just going, this is absolutely incredible. So to Scott, to your point, at the very beginning of the show, Amazon has created a lot of ways to think about the supply chain and inventory. It just blows my mind. And so, with that being said, you said in the beginning, Scott, tackling 4 different things. Where should you all start right now when it comes to this conversation? What's the most important thing we should tackle?
Yeah, let me come back to that question. Let me just give a point of clarification, right? Because most people don't understand Amazon, for example. So let's get a baseline understanding of what Amazon is. They're a marketplace. So all they're doing is making products available in a marketplace setting. They aren't really a retailer. They're venturing into being a retailer because they're seeing the activity that's happening by their subscribers, and they're seeing where there's opportunity for them to go and actually undercut the clients that are on their site by them doing private label products. So a lot of folks have decided that Amazon is the marketplace of choice. I would send a warning signal that, hey, that's great. You can't avoid it because that's where a lot of shoppers go, but recognize what you're giving up. You're giving up visibility not only to the things that are selling, but you're also giving up visibility to where they're selling. So that's just as important for you as a retailer or somebody who's selling your products. You want to know where your products are being sold. If you're using Amazon, you lose visibility of that, and Amazon has all of that insight, right? So you need to think about, as we go back to where we've talked in the last session, everything that an organization does should be in a strategy. It should be a defined strategy. What are you doing now? How does that get me to where I want to be? What are the strategic components? And I would warn a lot of folks that are leveraging Amazon as their main source of selling their products that they're giving away a lot more than they realize. They're getting revenue short term, but they're giving away visibility long term. And that visibility is critical in understanding how to set up their supply chain for efficiency, right? Inventory is one of your best measures and insights financially into how efficient your supply chain is. The more inventory you're carrying, the less efficient your supply chain is. And that could be caused by multiple factors. It could be caused, to your question, could be caused by demand and your inability to forecast demand because you don't have any visibility or insight into or mechanics to mine your data to understand the customer profile, the demand profile, what's driving their behaviors, and being accurate in that forecasting process. Most organizations have spent all of their time focused on forecasting, being more accurate in the forecasting. I would tell you that in this day and age, that's great, but you've missed the mark. The mark is over right now in the supply chain. The length of the supply chain and what happened in the pandemic was the variability in that lead time. And because people weren't keeping their eyes and their ball, on that ball about lead time variability, they didn't understand the shock that happened during the pandemic. And when that shock went away, because what happened was basically during the pandemic, lead times elongated. As the pandemic began to release itself, lead times began to shrink because most organizations aren't watching lead times, and that's just nothing but an input into their ERP. They weren't responding appropriately. So at the beginning of the pandemic, they weren't putting in orders fast enough because the lead times were elongating. After the pandemic, they weren't now spreading out their orders because now lead time was very fast and they didn't need to have as many orders in. So what happened is they became over inventory very quickly, and they didn't understand why they were becoming over inventory. So if you're trying to get your head around where to start, everything we're going to talk about in Value Creation Nation is always going to be strategy focused. What's the strategy? What are you trying to accomplish? How do you differentiate yourself in the marketplace, right? What are your key success elements? Then based on that, how do you align your supply chain to ensure that you're delivering on those success elements? And so, for example, if the lead time, the order to the consumer receiving it is a critical element in your sort of profile of how you're going to grow your business, then you got to create a supply chain that's very robust and very dynamic. If that isn't, however, something you need as your roadmap for success in your strategy, then you can allow that to elongate a little bit, and you don't have to worry about it as much, which means your inventory doesn't have to be as robust as if it's a critical element in your supply chain. So the anchoring on what your strategy is critical to being able to determine what the right answer is for each customer. And the answer for each customer is unique to that customer and what it is they value and what it is their strategy values.
It's interesting, and totally agree with Scott, of course, but one of the ways that most companies, and I've been working with companies for 30 years, I've seen this evolution, is gone about trying to get a better handle on inventories through planning, right? Because you've got all these lead times to worry about, and more lately, you've got disruptions and everything else to deal with. Well, what's the main thing everybody did? They started what everybody knows as the S&OP, Sales and Operations Planning Process. And most companies set up one of these like this, and very few have made them work properly for a lot of reasons we'll probably touch on. But I think the one main reason is, to Scott's point, sales and operations planning is one of the operating model processes that's supposed to take the strategy and execute it. And it's lost a lot of its ability because of the long lead times and e-commerce and other things, which have shorten the time that people want to spend waiting for stuff. So we've got an extension of that called sales and operations execution, which narrows the window here for the planning of inventory. Once you do that, and no matter how good you get at it, you still haven't solved your problem because you're still in the planning cycle and things are happening every day in orders. I've heard somebody say recently, every SKU tells a different story. So Scott will touch on this, I'm sure, but if you treat your inventory as one big block of things, you'll never get it correct. So that's another point to be made here.
I mean, Scott, I don't know if I were you or if I was going to interrupt you there for a second, but I mean, so how should companies go about planning for inventories and product categories, SKUs, or other quantities? Like, where do we go from there? How would you encourage that? How would you consult in that?
Yeah, that's a great question, right? So Gene touched on sort of there are three methodologies to planning. There's a tops down planning methodology, there's what they call middles out planning methodology, and there's what they call bottoms up planning methodology. Your demand forecasting tools are typically running at a bottoms up logic. They're looking at each SKU, looking at the history of each SKU, and giving you a forward view based on historical demand of what they're forecasting that demand to be. The problem with that, however, is when you're looking at an item's history, what few fail to do is look at the assortment in general and look at where other items in the assortment may have been out of stock. And so a customer made a substitution to the items that were available in that assortment, right? So that's kind of what leads to bottoms up the best way to go. If I need to ultimately buy items, I've got to get to some place where I know a demand at an item level to be able to place the buy. So a lot of folks have stayed at that item level forecast on a bottoms up logic. The reason why you would typically move to a middles out logic is for the reason I just stated. I could be out of stock on certain items or certain assortments. And so therefore I want to plan it at assortment level. And then I want to allow my history to blow down at the item level, saying that the assortment and the mix of sales is more important than the individual items. And that if my customers demonstrate a willingness to basically substitute or transfer their demand to what's available, then a middles out logic is more valuable and more insightful to the business than a bottoms up logic. If your customers, however, are not willing to make that substitution, then a bottoms up logic is much more insightful than a middles out logic because they're saying they're going to buy that part and only that part and no other part. So it's really dependent on your consumer demand to the products that the company that we're working with is selling. What logic is more important to the business? Now you get to tops down because I haven't talked about that. Where does that play? That plays when you have a company who basically believes that they've got to hit their margin targets and the revenue targets, and that supply availability and their ability to manage their supply base is a challenge. So what they're going to do is they're going to prioritize the items that they get from each supplier and blow down and say, this is the assortment that's going to be available. Where do I prioritize how I'm going to invest my dollars? Whether they're lean on working capital and they've got to make prioritization on where they're going to use their money to buy inventory, or they have a supply base that's very unreliable and they have to put pressures and prioritize the items that they can get their hands on. A tops down logic is one that's deployed to be able to determine what they need to prioritize to be able to deliver to their, not only their customers and the consumers, but also to their shareholders and drive the value and returns that are required. So if you're in a stressed situation organizationally, inventory is a premium and your investment in inventory is a premium because you're struggling with working capital, you're going to have to start prioritizing how you're going to use the assets that you have. And so you're going to probably do a middles out at best or a tops down at worst to be able to prioritize how you're going to use your working capital to be able to fund the business. So it all depends on where you are in the availability of your working capital determines the methodology you deploy, but also how your customers respond to your assortment and the trade-offs that they're willing to demonstrate will determine from middles out or bottoms up methodology what the right application is for your business.
Right. So as Scott says, it's certainly their tools are better today for doing planning, forecasting. AI is now helping some companies with demand forecasting, and that's fine. But there's still limitations on this process. One being the financial aspects of S&OP have never really been covered very well. So a new tool out there is integrated business planning, where it gets more of the business involved in planning inventory. And some of this has been proven to be okay with digital twins and so forth like that being used to do some scenario planning and things of that type. But despite all this new tools of planning, we still have, as I said before, the things that happen in the supply chain, disruptions and others that were not planned, not predicted, and therefore people try to adjust on them the best that they can. And it's difficult. It's difficult, but you need a process, and we'll be talking about this. You need a process that does more than just has those meetings once a month on what to buy. Go ahead, Scott.
Yeah, let me ground us on, because you called out a couple terms. S&OP and IBP. What is it they fundamentally do? They basically ensure collaboration of all the key constituents in the business related to not only the inventory that will be purchased, but how will the business deliver on the revenue and profit targets of the business? Okay. So what it does is it starts typically with an analytical exercise that goes through what we just talked about. How do I want to forecast my business? And that's an analytical exercise. That's typically fed over once they get their consensus to the sales side of the business, who then has responsibility to evaluate what the analytics tell you and determine what they're comfortable delivering, right? What their customers are looking for, their consumers, and whether the analytics are true or whether the competition is causing things to happen in the marketplace that the analytics aren't telling you, so that there's collaboration between the analytical exercise and the market intelligence. That then, once their line gets thrown over the fence to the team that does sourcing. So whether it's a manufacturing organization or a product sourcing organization, it gets fed over to say, what can our supply base feed to us, and or what raw materials do I have, and or what can my suppliers deliver, and can they deliver it when I need it to be able to fund what it is the other two teams have aligned to. If they can't, that then feeds back up to the sales team as well as the demand team to then get collaboration so that all three parties now are in alignment with the idea that the business is collaborating and providing a commitment to the executive team on what it is the business will deliver. At times, they will have disagreements on the prioritization because you're going to have vendors say, hey, I can't do all of that, but I can prioritize. Tell me what my priorities are. Those things that the team through collaboration can't work through then gets presented in the S&OP meeting, which most people are used to seeing, which in that meeting, it recaps how we performed last period, what we planned, what we produced, and then it gives a full review of what we're planning for the next period and what we're committing that we're going to deliver. And then it asks for executive sort of to weigh in and arbitrate to align the team on what those tough decisions are so that the team can then align. S&OP and IBP are nothing but a collaborative process. The meeting is nothing but the actualization of that collaboration process that's seeking executive sort of arbitration so that the teams know what the executive team wants the rest of the teams to do and the commitments that they're all making. So at the end of that process, they're all holding hands, marching into the forward period, saying this is what we're going to deliver. And if they can't deliver that, it's their responsibility to call out to their partners, right, what they can't deliver, as well as to the executive team why they can't deliver, so that that collaborative process continues. The process is meaningful only in that its ability to facilitate collaboration and the unification of vision. If the S&OP process doesn't result in a unified vision, then the process is broken. So the process isn't valuable in and of itself. The process is valuable in that it forces a structured collaborative process that then should become the cultural DNA of the business. And the S&OP process does nothing but facilitate, one, holding each other accountable, and two, ensure that all the proper teams collaborate in the sequence with the right timing to ensure that they can deliver what it is they're committing to for the business.
Yeah. So one of the things we start when we work with a company on their inventory is we look at their S&OP process among the first things, issues that Scott's raising and what's right about it and what's wrong about it. You know, I've had a lot of companies consider it to be a discipline where it's on a schedule each month, and that's what it should be. At the end of the month, the CEO has to sign on the plan. Most companies got away from that because they weren't getting to happen so well. And sure enough, they typically have these meetings once a month. They walk away thinking they're unified, but they're really not. Half of them are upset, are tired of it. The other half are just saying, well, whatever. So it's not working very well. That's a telling sign right now that the current state is in trouble. Okay.
So remember, inventory is that one financial metric that if a business wants to look at any metric, any scorecard, any single KPI in the business, inventory is that single metric that tells you how effectively the business is running or how ineffectively the business is running. The better the team is at collaborating and working through their issues and aligning to deliver the commitments from a revenue and profit, and the ability to keep that inventory as lean as possible tells you how effectively the teams are collaborating and moving customers to products that they have, or they're not collaborating and they're sort of pointing fingers at each other, and they're not hitting the revenue targets because they're not in alignment with how they're going to move in their supply base as well as their customer base and consumer base to be able to consume the products that they have.
Incredible. And so it's such, I will say this too, such poise in the last 7 minutes. And as you guys can tell, if you're listening to this show right now, these two are experts in their field, and you even had a dog in the background. And so maybe one day during the show, we're going to, was it Scott or Gene? Whose
It
dog
was
was
me. It was
it?
me. That was Bo.
Bo. Well, so maybe we'll get Bo on here one time. That was extreme poise during that. But as you know, from a standpoint of I'm not an expert in this industry, but I know in the podcasting world and in the listening world and watching, stuff like this, like stories give a great example of, this is where I'm at as an organization. So I'm going to put it on you guys a little bit. And I'm curious of a client that you all have worked with. What were some frustrations that they were experiencing with inventory? What were you guys able to do? What did you look at? How did you turn things around? So
Yeah, let me give you two best cases. So I'm going to give you sort of the leaders in the industry and what they're doing and how they're so effective. Okay. Walmart, as an example, is very good at this. So the everyday low prices, what they're doing is they're looking at the velocity of sales, knowing what the inbound supply is going to be, and they're lowering prices as needed to be able to exit the products they have, to clear the shelves, to make room for the next products that are coming in. So they're all about velocity, knowing that inventory and space is a premium. The footprint on the floor is a premium. And so they watch velocity very closely. And that's what the everyday low prices is designed to be able to control, is ensure that they get the sell through to clear the space, the shelf space and the floor space, to be able to move the next inventory that's coming so that it doesn't sit in the back room. It gets exited, and they'll drop prices to ensure they get the velocity to do it. That's one example, and that's mass merchandising moving high volume. The other side of that also does a great job of that is Victoria's Secret, who I work for. Victoria's Secret was very good because they have 13-week floor sets. They were very good at having new fashion colors come in every 13 weeks. They would do a seed and chase logic. So they would seed in a 5-week supply of the new fashion colors, look at the performance of week 1 and or week 2, and then make a decision very quickly on the tail end of those remaining 13 weeks to determine what colors they chased and expedited in, or what colors they exited. And when they exited colors, they exited very quickly because they knew they were duds. They didn't wait till the end of the floor set. They would reduce to the price of those items early in the floor set because they knew traffic would come for the fashion colors, and they were reducing the price on the bad colors that weren't hot during a time when they had the traffic to be able to consume them. So those are two real examples of companies that have been very successful at understanding the couple things. One, demand forecasting is critical, and they both have invested heavily on processes to try to forecast demand and be better about it. The other is they've recognized the cost trade-off between inventory velocity and margin and price point, recognizing that there's a trade-off between the two, and recognizing that inventory management always has to play this trade-off between how much margin you're going to deliver per unit and how much inventory you're going to carry, and the need to continue to clean inventory to get to the fresh stuff to keep your working capital as optimal as possible. So those are two life examples of businesses that are using those processes very successfully.
Yeah, I'm not going to name names because it's not fair, but I could mention a lot of companies in the middle market that have been struggling with this for years. And we've been working a lot, Scott and I, in the middle market the last 10 years. And the fact is they're doing so many things that are not leading practices like the two Scott talked about. And I can name a lot of others that are not in retail that are damn good at it. But the middle market companies that are not, either they did not have an S&OP process, and we had to set one up for them, or they had one and it was stuck. They couldn't get that unified position out of it, so they just gave it up and went forward. Or three, they were unable to get forecasts well enough that the supply side, the people who are buying or making the products, said, we're not going to go with your forecast, we'll go with ours. Then we had 2 different forecasts, and sometimes we had 3 or 4 different forecasts in a company. So you've got to get that down to the single number forecast to make it work right. So that's where a lot of companies need the help. Beyond that, though, there's so many other things that have to go on to make inventory inventory really a competitive weapon we talked about, where you're making profit at it, you're minimizing your working capital, and you're using metrics. We haven't talked about metrics yet. It's important to measure how we're doing in inventory in a lot more than one or two metrics. And even today, we've got to be careful we're not just measuring the past and we're not using leading indicators to look at the future. So there's the current state with all these problems that need to be worked on. And then there's what do we do to get to the future state of inventory management? If you sit down with people like us and others that know what inventory is all about, what does the future of inventory look like? You really get some interesting thoughts on the wall there. And that's where I think everybody has to sort of have this growth plan. How can we really make inventory management working well for us?
Yeah. It's funny when I'm sitting here thinking about when we're planning the show and you guys wanted to, obviously the topic of inventory management, I think one of you said we may need a couple of shows for that as obviously that is exactly what we may need. But I'm curious as a consumer, obviously, and not in the world that you guys are in, is it a fair assumption to say, and this maybe just be selfish for me to ask because I'm very curious, is it safe to say that the companies that I know and that I buy from that are constantly changing their prices are very good at the supply chain, kind of talking to what you all were talking about? I mean, I thought it was maybe they're just flippantly trying to sell stuff, but is it safe to say that if they're just really good at the supply chain?
So remember, there's balance between profitability, competitive pressures, and inventory in the supply chain. So there's any reason why they could be adjusting pricing. They could be adjusting pricing because they're moving to the next model and they need to exit the one they have, and they're being aggressive to basically take that competitive item out of their assortment to move to the next item that delivers higher profitability, as one example of why they may reduce price. Or they could be in a time where their competitor has introduced a new product and they need to transition, and they're trying to basically put in a competitive sort of stonewall, if you will, to drive customers to them, knowing that their product may be equal to or slightly inferior to what their competitor has just offered. And so they're trying to find a way to be competitive without introducing a new product while they sort of buy time to introduce a new product. Or they could know the amount of inventory that they purchased and what's on the way. Because of the long lead time, you get anywhere from 6 to 8 week lead time if you're over in Asia. If I'm already sitting on a stockpile of inventory and I know I've already bought for the next 6 to 8 weeks that are already on the water, and I've got a huge surge of product that I bought for expecting an upsurge in demand, but it's not materializing, hey, I've got to do something aggressively to clear that working capital because I don't want to sit on 5 years worth of supply. So there are a number of reasons why price would be adjusted by the company that's selling their goods to an end consumer. Could be competitive, could be financial. They're trying to clear working capital. They have some other initiative they want to use that capital for, and they've determined that they need free enough working capital to be able to do that investment. It could be they're exiting a certain category, or they want to change their focus in a certain category. There are a lot of reasons why we've not talked anything about assortment planning, which is another huge discussion in this idea of inventory and inventory management, right? What are you offering? Why are you offering it? Do you have competitive offerings in the same assortment? Should you have those? Should you trim your assortment, consolidate sort of what you're offering so that you minimize the inventory investment that you have? There are a lot of reasons why that could occur. That's where each situation is unique and different. But, one indicator most likely is going to be competitive pressure.
Yeah, but another reason that some companies are just taking the new tariffs and taking what they're paying in tariffs and adding that to the price. So
but that wouldn't be a price reduction. That'd be a price addition.
That's what I mean. They're adjusting the price up because of that. They might tell you that if you ask them, but why their prices are higher? Well, because we're paying tariffs. But see, that's not necessarily the right thing to do.
Well, it sounds like we need an inventory management part two to talk about
so.
that stuff.
We got a whole lot to do on what solutions we bring to the table. I mean,
so that's the thing about inventory. Inventory is made up from several processes that have to work in harmony as a result of what is the buy, right? So inventory comes from two ways, very fundamentally. One, what I buy and bring into the business, and two, what I sell and exit the business. If what I bring in does not match what I get out, then of course inventory is going to balloon. So one of those two processes one of those two dials has to be adjusted to be able to accommodate for whatever's happening in the marketplace. So if I'm not selling fast enough, but I've got more flow and it's already been bought and I'm committed to it, then that means I got to do something to increase demand, whether I run an event, whether I do reduce pricing, or do I create bundles Do I put products together, some of which are higher movers, but I put them together as a collection and offer an assortment? You see a lot of that happening during holiday seasons, whether it be Father's Day or Christmas or other holidays, where I'm going to put things together and I'm going to take slow movers and bundle them together with fast movers and try to sell them off through that window by creating an assortment. So I get rid of things that are sort of lagging, right? But inventory, and that's why it's a multi-session discussion, is because in future sessions, we're going to rip apart each one of those processes and talk about how do you optimize each of those processes to be able to drive down overall inventory and lean out and increase your working capital, as well as the profit and value that you bring to the business.
Right. And we've got some ideas for internal changes that as well. So yeah, we need another session on the future state.
So let me, Elaine, with that idea, it's important that the name again, value creation. Value is not just revenue, right? Value is multiple things. Value can be, from a consumer's perspective, your order to receipt time. Value can be the amount of working capital that's available. Value can be the ease of which processes work between pyramids within the business. Value can be how the team collaborates to align in the business, right? Value could also be from an investor perspective, which is, what is my return? So value is a very vague term, but an important term, because the value that's being created by the business is dependent on the perspective you have of the business and what it is that is important to you and how you want to measure the performance of the business.
Yep, exactly.
Incredible. I want to give a challenge to the audience right now and the people that may be listening to this to evaluate if their inventory manager, if they have it in line. What is something that they could look at right now and they could evaluate from this conversation? And what would you say to them? Hey, what is this working? Is this working? What would you say to that person to give them a challenge to think about?
Well, I'd start with metrics and say, let's look at, a lot of companies use general gross margin return on investment. So if I'm investing in inventory, what's my gross margin on it? So you can look at metrics like that and see how you're doing. You can also measure your stockouts. If you get an order, you don't have the product and you don't have it anywhere in your system, that's a stockout. You didn't plan for that properly. So there are different ways to measure how the inventory is performing based on the decisions we made months ago that you would look at. And there's new metrics available these days that can tell you more than we used to know about or think about with inventory when it was less complicated. I would say that's where you start, is let's measure how we're doing with some new metrics that have to do with financial and operations.
Yeah, I'll be a little more tactical in answering that question, Lane. So stockouts are going to come potentially from, I'm only using history and I'm not recognizing the substitutions that are happening within a business. I have that right now with a client I'm working with, right? They are looking purely at their demand, and their demand is a job shop type business. Customers will come in, they either satisfy that order immediately or the customer will go somewhere else. The consumer will go somewhere else to buy it. In their scenario, you either have it or you don't. And what happens is they're going to fulfill the order with what they have. Well, if all you're doing is using history to be able to gauge sort of what your demand is, you're missing the idea that a lot of substitutions are happening. So you're not buying what they really wanted. You're buying what it is that you had available to be able to support the business. So the idea of demand forecasting has to recognize that history can be used as a guide, but you need to ensure that the history you're using takes into account when substitutions occur and you add stockouts, to Gene's point, and then that history needs to be revised so that when you forecast in the future, you're forecasting your true need and not what it is you actually delivered with the substitutions occurring. Because if all you do is continue to forecast your substitutions, then you're going to be over inventoried with the substitution items and never buying the items that were purely desired, right? So stockouts is a good one. I would say if a business doesn't have an age-based reserve process where they look at their aged product and they automatically begin to take a write-off reduction based on some kind of time phase basis, the emotional discussion and the turmoil that the business goes through to acknowledge that inventory they invested in actually has a decreasing value in the marketplace is one that every business struggles with, because they never have enough profit to be able to cover the write-downs that they need to do because it's not systematic. And unless they bake in a write-off process that uses an age-based reserve, so it's automatically being deducted from the profitability of the business, so that if it sits there and it gets to a certain window, it's totally written off. At that point, those products can either, if they're sold to a customer, then you get, 100% profit. If they aren't sold, then you can basically trash them, write them off or whatever, and there's no harm to the business because it's already been accounted for. So unless the business has a structured way of dealing with dead items, aged items, and items that are going end of life and or have limited market value, businesses continue to struggle. And this is very important, particularly with businesses that are using inventory as a way to fund their business, right? So businesses kind of get themselves handcuffed. Sometimes they'll go to a bank looking for a loan. They'll tie the loan to the amount of inventory they're carrying because that's the only asset that they have. And so therefore they're kind of handcuffed if they want to reduce the value of inventory. And that's what's been used to be able to support the funding of the business. They're kind of stuck. What that does, however, is it ties up working capital and stuff that's going to generate no revenue. And so you get yourself into this perilous process where you never get rid of stuff. So, 10, 15% of your money for inventory is tied up in stuff that you very likely won't sell or give you no revenue. If you do sell it, it's going to give you very little revenue because that has very little market value. It's those kind of things that a business has to look at critically and set up processes to protect itself from thinking it's got value when it really doesn't.
Yeah, I was going to mention this too. I can't think of hardly any warehouses I've ever walked through, and I've walked through over 100, I'm sure, maybe 200, that don't have some dead stock somewhere. The term lately is zombie inventory. It's inventory, to Scott's point, that's overaged. It's just sitting there because people think, well, maybe someday it'll be sold, or we don't have the wherewithal to dispose of it. We don't want to take a write-off. It's just sitting there gathering dust, and it's just another problem in inventory management. What do you do when returns are the same thing? What returns do you probably take that on in the next session as well? Because Scott knows all about returns.
I selfishly want to know a ton of stuff in the supply chain world because returns and everything, what happens. And so we'll need a part 2 of this, if that's okay with you guys. Obviously, I want to be able to have a part 2 in this. And so, yeah, I think inventory management is it was a good first topic here after the pilot episode. And so, with that, if you're listening to this right now and you know that this episode added value to you and your business acumen or something in your organization, make sure to share this show with someone within your network. Share it either on LinkedIn, share it on there's Apple and Spotify, or wherever you listen to your podcast. And then also, if you could do a favor for Scott and Gene, if you could go over to Apple, if you could scroll all the way down to the bottom, give them a 5-star rating and a 5-star review. That's how they get this show out. That's how they can make it popular. And if you're on YouTube, go give them a thumbs up and give them some feedback. Also, in the show notes, you will find their LinkedIn profiles. Make sure to go connect with them. Tell them what you liked about the show. Tell them what you got from the show. And then again, make sure you tune in for future episodes of Value Creation Nation. Gentlemen, have a good Father's Day weekend. We are heading into the Father's Day, so this episode is going to come out after Father's Day. So if you were a father listening to this, hope you had a great Father's Day, and to you, happy Father's Day as well.
Same to you.
Thanks, Lane.
Thanks, Lane.